Hey, it's Dr. Gold. We're up to chapter 4. Wow, the semester is really moving along here. And this is the chapter where we begin to learn about different ways of extracting data from the financial statements, the income statement, the balance sheet, the cash flow statement, extracting little nuggets of data to allow us to sort of size up the company, excuse me, and the enterprise and make a determination of, A, is it in healthy condition? B, is it well managed? C, is it under or overvalued? And sort of begin to apply some of the tools that are available to us in our finance toolbox, so to speak, to being able to assess and answer those questions. Now, within the world of finance, we do financial statement analysis for a lot of reasons. One of the reasons I just mentioned. Another reason is we do it because shareholders demand that we do it. And we're compelled to do it because the law requires that we do it for certain types of corporations. Those aren't great reasons to do it, but they're nevertheless reasons for why we analyze financial statements. A third reason is on Wall Street, we have a whole segment of highly paid workers called Wall Street analysts. Now, the job of a Wall Street analyst, if they're a fundamental analyst, is to access financial information from companies, calculate all of these ratios that we're about to discuss, visit with the company, visit with management, compare and contrast companies within their peer group to see which ones are stronger or weaker than others, and then come up with a research report about that particular company. Should shareholders buy the stock based upon their analysis? Should shareholders sell the stock if they own the company based upon the research analyst's report? Or should they simply just continue to hold on to it because it hasn't reached its maximum value according to that analyst? Now, of course, there's a tremendous school of thought out there that says the efficient market hypothesis argues that because markets are efficient, and because you as an investor can do no better or worse than the market overall, why would you pay a research analyst working at Morgan Stanley a whole boatload of money to analyze stocks when it really doesn't matter? Obviously, there's a whole bunch of people that think it does matter, but I just want to share with you the sort of conflicting perspective that exists within the field of finance. There are some very, very smart, scholarly individuals who believe in the efficient market hypothesis. And then there are many people who say, well, that's hogwash. Of course, there are people that can outperform. And, if you can identify on undervalued assets, you can make a lot of money for yourself. So there's a lot of reasons why we go about analyzing financial statements, and I've just sort of touched on some of them. This is a graph of a table rather of this company that the textbook references called Boswell Incorporated, and it just kind of shows, instead of numbers, absolute numbers, percentages. This is one form of viewing a set of financial statements, because then we can compare and contrast percentage or relative gains or erosions within the financial data that we're looking at. So we can see here, just looking at the top of this income statement, that the company's cost of goods sold declined by 75%, and their gross profit margin was 25%. And you can see different data points as you go through it. This table here compares and contrasts this company's performance over a 2-year period of time. Now, here we start to be able to see some interesting things. And this is the company's balance sheet. So For example, column 1 is, I don't know if you can see it, it says 2009, column 2 says 2010, and then the third column says change. Now we can see that their amount of cash that they have on their books in the balance sheet went down. The accounts receivable, or money that's owed to them from customers, increased a little bit. Their inventory increased quite a bit, over that period of time for some reason. Who knows? Maybe people aren't buying their products as much anymore. Maybe they're expecting the economy to take off, so they've built up a lot of inventory. There could be a lot of reasons for that. When you look just quickly down in the liability side of the balance sheet, you see that the accounts payable, which is money that's owed to vendors and so forth, basically stayed the same. It was down almost 1% or so over the past year. Their short-term notes, which are loans that the company incurred, also fell. And in general, their total debt declined by almost 4%, which seems pretty good. So you can kind of use percentages to make relative comparisons, and I just wanted to illustrate that and talk about that because that's an important thing to do. All right, the financial ratios are broken down into 5 categories: liquidity ratios, capital structure ratios, asset management, or commonly referred to as efficiency ratios, profitability ratios, and market value ratios. Now, I'm not going to go into detail on all of these. You should read Chapter 4 and watch the additional videos that I provided you with. But let's start with liquidity ratios. Can the company pay its bills? Yes or no? And I always like to try to get students to sort of personalize stuff that we go over in the class about companies and financial statements with their own lives, because sometimes kind of we're more comfortable with our own lives, and there's a lot of similarities between how we manage our own life and how companies sort of manage their existence. So on the notion of liquidity ratios, can the company meet its bills? Does it have enough liquidity, or can it convert stuff into cash so it can satisfy the debts or obligations that it has coming due over the short run? Now, on a personal level, of course, in your own life, you may have rent and food expenses and electricity bills. And the question, of course, is what do you do when you're unable to satisfy those bills that are coming due? The preference is not to starve, get evicted, and have the electricity turned off on you. So what do we do? Well, most people in life and sometimes in business put blinders over their eyes, on the sides of their eyes. And they don't look, and they don't look up, and they don't look around, and they don't try to analyze the situation and detect problems early on so you can implement some changes. For example, in your own personal life. If you detect that you're struggling month to month to meet your expenses, of course there are a lot of things you can do. They're not pleasant things to do, but there are things you can do nevertheless. You can get a second or third job. You can eat out less and reduce your expenses. You can sell an asset and convert that into cash. So you have a little more cash on hand to be able to satisfy things. You can do things within your own life, but a lot of people choose not to do that, and that's kind of how the financial hole they're in gets bigger and deeper, and then ultimately becomes very, very difficult to get out of. The same is true with companies. They need to have objective lenses that can kind of analyze whether or not they're going to be able to satisfy the bills that are coming due, and if not, what steps can be made to line up capital to be able to satisfy those. Should we put our inventory on sale so it attracts more buyers and gets us a sort of rush of cash flowing into our business so we'll be able to meet those expenses? Should we sell an asset, a piece of land or property that we own, so we can get that money flowing in to pay our bills? Should we go to the bank and borrow money for 6 months in order to do that? There's lots of things that you can do, but depending upon economic circumstances and depending upon the ability of the company to be nimble will dictate whether or not it's able to do that. Now, capital structure ratios basically says how has the firm financed the purchase of its assets. Now, you can finance the purchase of your assets, as you know from the chapter on financial statements, in one of two ways. You can either borrow money to purchase the assets. You can get investors to put money into the business and give them ownership in exchange for that to purchase assets. Or you can use profits from the business that flow through into the balance sheet, into retained earnings to potentially make some purchases of assets. You have to be a little careful with that one because it's very important for you to know that because the net profit for a business, as we talked about, is not necessarily cash or not all cash, when it converts into retained earnings, it doesn't magically all of a sudden become cash either. So just because you have X number of dollars in retained earnings doesn't mean you can buy anything. It might mean you could buy something, but it may mean you can't buy anything until the customers who have not yet paid you pay you. So when you're looking to pay for things, you can either do it through cash that the company has, borrowing money, or getting additional investment through the sale of stock. Asset management, or commonly referred to efficiency ratios, it basically says, as the question it says here in red, is how efficient has the firm, has the management of the firm been in utilizing its assets to generate sales? So is the company, sort of poorly managing its inventory, for example, or not? Does it have a high inventory turnover ratio, for example, or not? What basically are the things that the company's doing well or doing poorly? Profitability ratios are things like the gross profit margin, the operating profit margin, the net profit margin, and those things are simply calculated by taking the gross profit, which is, for example, the net income, the revenue minus the cost of goods sold. That's your gross income, and then dividing that into your revenue. So if you have a revenue of $100 and cost of goods sold of $50, then you have a gross profit of $50. You then take $50 and divide it into 100, which is your revenue, so you would have a gross profit margin of 50%. Then, as you know, as you're flowing down an income statement, you'll have your operating expenses. Now, if your operating expenses equals $25, well, then you deduct $25 from the gross profit of $50, and that leaves you with an operating profit of $25. You then take $25 and divide it into $100 to get the operating profit margin. In that case, 25%. And then the net profit margin is your net profit, after a deduction for interest and after you've paid taxes. What is your net income? Well, you take that amount, let's say it's $10, and you divide that also into revenue to get the net income profit ratio. And then the last one is the market values ratio, which covers things like the price earnings multiple, looks at things like the book value of a company, which is, really like at its core, if a company goes into bankruptcy and has to sell off whatever assets it has, how much, will that turn into in terms of cash per share of stock? What's the book value per share? I'll have one more video that'll sort of touch on some of these ratios in a little more detail in this module as well, but I just wanted to kind of brush over and touch on what some of these ratios are, how they're sort of positioned within the scope of doing analysis and so forth.